Hi everyone, let's continue with Chapter 3. In this video, we'll analyze the relationship among sub-accounts of BP. We are going to analyze the balance of sub-accounts including net current account, net capital and financial account, net errors and omissions account. Then, we'll analyze overall BP. In the course, we'll use shorthand notation. CA is for current account balance. KA is for capital and financial account balance. No shorthand notation for net error and omission and overall BP. Firstly, let's analyze the relationship between net current account and the national income. Approximately, when the account of primary income and second income, that's current transfer, are ignored, then the current account will be equal to the trade account, which can be expressed with the following formula. CA equals X minus M, in which X represents export, M is for import. And from what we have learned from the macroeconomics, when we calculate GDP with the method of expenditure approach, GDP equals to consumption plus investment plus government purchaser plus net export, which is export minus import. So we will get the equation current account equals to trade account equals Y minus A. In the above, Y represents GDP, A equals to the sum of consumption and investment and government purchaser. A is the domestic absorption or domestic expenditure. If Y is bigger than A, then X is bigger than M, current account is in surplus. If Y is smaller than A, then X is smaller than M, current account is in deficit. The economic meaning can be explained as following. When national income is larger than domestic absorption, then export is larger than import, which means current account is in credit. Vice versa, when national income is less than national expenditure, then the country has to export real materials to satisfy domestic demand. Also, the meaning can be explained as when the current account is in deficit, a country can improve the deficit by decreasing domestic expenditure or increasing national income. This simple model shows the linkage between internal and external economy of a country. The above is about the relationship between current account and national income. In the following, we'll analyze the relationship between current account and financial account. Still from macroeconomics, we have learned that when we calculate GDP with the method of expenditure approach, we'll get Y equals consumption plus investment plus government purchaser plus export minus import. Well, with method of income approach, we'll get Y equals consumption plus private saving plus tax, in which SP represents private saving and T represents tax. So we will get investment plus government purchasing plus export minus import equals private saving plus tax. By moving and changing, we will get export minus import equals private saving plus tax minus government purchasing minus investment equals private saving plus government saving minus investment. The sum of private saving and government saving equals national saving S. So we can get current account equals export minus import equals saving minus investment. If national saving larger than investment, then export larger than import, current account is in surplus. If national saving less than investment, then export less than import, current account is in deficit. This is the conclusion, but how to explain the meaning of the macro meaning? We will take the situation that current account is in deficit to give an explanation. Current account is in deficit, which means saving less than investment. According to classical school of economics, the equilibrium rate of interest will be decided when the level of saving equals to the level of investment. When saving level less than investment level, then the interest rate will rise, which induces financial capitals to flow in, which means the deficit of current account will be supplemented by the surplus of financial account. This is the funding mechanism between current account and financial account. However, there exist some limitations with the funding mechanism, including the cost of funding can be high, the payments of interest will increase the cost of funding, and if the borrowed capital can't be utilized efficiently, then it will be a problem to return the interest as well as the principal of the borrowed capital. Finally, the inflowing capital funding in such way is usually unstable. Any change in the domestic economic environment and the change of demand and supply of international capitals or some emergency will cause outflowing of foreign capitals. Use this economic theoretical model to analyze the economic development model of U.S., we can draw a conclusion that the U.S. was using the borrowed money to import goods to satisfy the domestic consumption. Now, let's analyze the relationship between current account and the capital and financial account. Approximately, when the net error and emissions are ignored, then negative net current account equals to net capital and financial account balance. In the formula, KA represents net capital and financial accounts balance. Macro meaning is that when current account is in deficit, then net capital and financial account balance should be in credit, which means the country can fund the deficit of current account by decreasing financial assets. Okay, in the video, we analyze the balance of sub-accounts. The relationship between current account and the national income shows the linkage between external and internal economy. When national income is larger than domestic absorption, then export is larger than import, which means current account is in credit. Vice versa, when national income is less than national expenditure, then the country has to import real materials to satisfy domestic demand. The relationship between current account and financial account is reflected from the formula. It indicates if saving less than investment, then export less than import, current account is in deficit. This model reflects the relationship between current account and financial account, because when saving less than investment and the current account is in deficit, then the interest rate will rise and induce financial capital to flow in, which will bring about the surplus of financial account. This is in fact a financial mechanism between current account and the financial account. When the net errors and emissions are ignored, negative current account equals the sum of capital and financial account, means a country can fund the deficit of current account by decreasing financial asset. The conclusion is the same with the second conclusion, though they are derived from different roots. That's all for the section. Thank you.